Financial Transformation Live. I've got a bit of treat for you this month. So I'm really excited to welcome Neil to this episode of Financial Transformation Live. So Neil looks after our transformation and delivery teams, and he's going to take us through our topic for today, which is understanding the P2P maturity curve. So welcome, Neil. Over to you. Let's get started.
Hi, good afternoon, everybody. Very pleased to be here on my first session in this Finance Transformation Leadership Forum. This afternoon, we're going to be talking about the purchase to pay maturity curve. In this session, we'll be looking at what the model is, why we use it. We'll be talking about how we evaluate the impact of moving up the model. We'll confirm the scope of processes that we're talking about when we talk about P2P. We'll come up with a definition for each of the maturity levels. We'll talk about the characteristics of those maturity levels, and we'll address any questions that come up. Okay. So a little bit of introduction about myself. A long and varied career, not necessarily quite linear, not conventional. Started out in the early days of computing in the 80s as an ERP developer, in fact, developing systems before ERPs were even a thing. Later on, I went on to be the purchase to pay process owner for a US pharmaceuticals business in the mid-90s and was in that role for over a decade. Had the good fortune to establish a global shared services organization within that pharmaceuticals company, which benchmarked #1 for its process and operational performance. I went on to have regional and divisional operational and leadership roles, always characterized by driving transformation through business. Later on, went into Big Four consulting and then into independent consulting. I've had good fortune to have successful transformation programs with various clients there and helping the C-suite executives to drive performance within their own businesses. And in terms of business experience, I've kind of worked across most European countries, so I've encountered many different regimes and challenges that exist across Europe. And I've had the really good fortune to work across many business sectors from kind of healthcare, pharmaceuticals, airlines, hotels, the nuclear industry, and even the Home Office for the government. So hopefully a varied career that can bring some perspective on lots of different businesses and challenges. Let's get into why we use a maturity model. So very simply, the only reason we really use a maturity model is to inspire the next step that a business can take. It's quite often challenging to think through how do we break down a great process into bite-sized pieces that we can deliver and have some success. Well, we're going to do that today. We're going to break down what moving through process maturity looks like into achievable outcomes. We're going to present it in what is quite a typical progression for businesses, but it's not prescriptive. It's completely there to inspire what you can do next, and what's right for your business might be different than what's right for other businesses. So there's kind of no, you've got to be at this point or that point on the maturity curve. It's totally about what's right for your business and to help in that thought process. Let's try to think about how we evaluate those steps. Given that we're talking largely to a finance audience around P2P, the whole evaluation is geared towards what a finance director or a finance team might be thinking about in terms of their imperatives. And we break it down into kind of 3 axes. One is looking at the impact upon the control environment within the process. Second is looking at, does this improvement drive efficiency, cost of operation, and the effectiveness of the process, how well it works. And kind of looking at the third evaluation in terms of, does this combine with other aspects to create business insights? Does it drive business value? And we'll map that against each of the maturity levels. Just to confirm the scope that we're talking about. So we're talking about purchase to pay. And what we'll cover today is the master data creation, maintenance of master data. We won't talk about necessarily how the need to purchase is determined. That's kind of treated, whether it be a production run, or whether it be for indirect supplies within the office of administration function or an engineering stores. We won't cover that today. What we'll cover is going into managing the purchase request after the demand is understood. We will not cover the subject matter of how to go about finding the right suppliers or the right ways to negotiate with them. That's a subject for another day. But we will go along with how we instruct the suppliers with the purchase order. We'll then go on to how we receive the goods or services or acknowledge the delivery within our company. We'll talk about invoice processing, and I've split invoice processing in terms of recording an invoice to separate it out from the release of the invoice for payments, so we can talk about discrepancy management and how we decide that it's right to pay and when to pay. We'll talk about the actual payments cycle itself. We won't talk about clever treasury stuff around managing funding and revolving loans and cross-border payments, but we'll mention a little bit, we'll hint a little bit about it. And then finally, we'll talk about the topic that's often missed when we talk about process design, the process management itself. So having an overview of how well the process is working and how it helps your business to be more successful. And so we'll look at that as a topic in its own right. So if we think about what levels we'll have on a maturity model, we're keeping it simple. We're going to use the same 5 levels throughout. So kind of a little bit of, kind of grouping things together in a sensible combination. The first level we're going to talk about is basic transaction recording. So this is where the process is at its simplest. It's at its most basic. You could argue it adds no value other than being a system of record for your business. But that's right for some businesses, but we'll look into that. In terms of whether it adds control or insight or efficiency, it's kind of low down on the scale. Then we'll talk about transactional control. So putting in place a process that puts some business rules in place around the transaction, put some controls so that you can have comfort that the business is working the way you want it to work and that you're not exceeding limits that would put risk into your business. So that obviously helps us to drive control. And in doing that, we'll also talk about some of the efficiency gains that we can have. Then going beyond that, we can talk about process efficiency in itself, really taking that up a step, sort of talking about automations and enablement, and how we can start driving out the cost of operation. And inherently, that brings further control as well. So we'll see that there's both control and efficiency driven there. The next level up, and we're starting to get into kind of enterprise level maturity, is when we start talking about how do we get the best value from the relationships that we've negotiated with our supplier base. How do we make sure that they're working well for our business? How do we take transactions through those relationships rather than have maverick purchasing? So that would obviously help us to drive business value and insight, as well as maintaining the control and the efficiency. And then finally, we will talk about kind of strategic process leverage. So how do we use the process itself to achieve other goals in our business to drive added value for our business? Now, when we look at these 5 levels, as you might imagine on a maturity curve, the bulk of players in the industry are around levels 1, 2, and 3. It's a few entities that can kind of really get themselves up into the maturity levels 4 and 5. It takes some investment, it takes time and energy, and it also needs to reflect some value back for your business. But we've included them today because they might have ideas there that are inspirational to other businesses as well. And so we didn't want to kind of clip this the maturity curve. We wanted to include the high-end aspirational outcomes as well as the the more common story that for the vast majority of businesses. So let's get straight into it. Let's talk about purchase requisitioning. Obviously, at the most basic level, we have no purchase requisitioning. So this is, when we talk about purchase requisitioning, sorry, I'm falling over my teeth, we are talking about the request to make a purchase. This is not an instruction to a supplier. This is a request within the business for approval and to buy something that we feel that we need, whether it be a goods or a service. At the most basic level, it could be verbal, it could be an email request. It might not even be existent. It might go straight to purchase order. And that's just fine for small organizations. That's very suitable for them. Kind of next level up is to actually start putting some flow and some transaction control around it. So kind of having a justified request, having an idea about how much it's going to cost, preempting the reporting of it with having the right count coding. So what's the nature of the thing that we're buying? What are we buying it for? Is it to run a cost center? Is it for a particular project? Is it for a build of an asset? We can make sure that we're getting the coding right. There are smart things that we can do about enabling our teams to make purchases that they need to keep the business running, with things like ghost cards embedded into transactions. So a ghost card is a credit card style transaction with a supplier, but it's an electronic credit card, and that allows you to either allow somebody to purchase it in their own right, or you could put an approval process around it. The benefit of that process is that it can work for 24/7 operations, engineers needing urgent supplies and what have you, that kind of thing. And of course, we just mentioned the approval workflow. So this is making sure that the right people in your business are approving the requests before they go out as an instruction to a supplier. And of course, the benefits of that are we have some cost and control, some budget management, and we can enable our teams to be buying appropriately to keep the business running effectively. Now, on each of these slides, we have included example enablers. I'm largely going to talk about this in a system agnostic way, but I have included some enablers across the bottom of each slide so that you can get a sense of what kind of tools can enable these steps within each process. But I won't be referring to them too much, but they're there for your viewing. In terms of purchase requesting, the next level of driving efficiency is to start automating the process to help the employee to be successful. So if you think the person who is requesting is generally not spending all of their time buying stuff, we need to make it easy for them to request the right thing and request it in the right way. So we might have a solution that suggests purchases kind of Amazon style. You bought this last month, do you need it this month? Kind of thing. We can also have templated purchases for complex purchases. So if somebody needs to buy a kit on a regular basis, we can have a pre-stored requisition with that kit as a template. We can include the right account coding, the right routing for approval, and make life a lot easier for the requisitioner. We might have common purchases based on the nature of role that somebody is performing. We can start exploring self-approval limits. So we talked about embedding a credit card style transaction into requesting. We can also embed approval limits for transactions that will go to a buyer to buy or go straight out to the supplier. And you could put in a safe limit. I worked in an organization where we went from kind of allowing people to spend around £500 without seeking cost center approval or cost center manager's approval through to £1,000, and then even higher for certain categories of supply. We can start putting things like source lists in to help the requisitioner get the right supplier for the purchase that they're trying to make, so that they can be obviously getting the right deals, getting the right specification of goods and what have you. And we can even bolster that with the concept of catalogs, whether that be an electronic catalog that you host, electronic catalog that your supplier hosts, and even custom catalogs that your supplier hosts, the things that you allow your employees to buy at the price that you've negotiated. So there's catalogs can be a really smart way of making it really easy to be a requisitioner in your organization. Obviously, as we start using these tools, we make life easier for our employees. It's reduced human effort. We start error proofing, removing that potential for the human error, and we start getting some consistency for analysis. So, for example, the right codes are being used in the templates, so the transaction always hits the right part of the nominal ledger. As we start going into strategic sourcing, this is where we're going beyond the efficiency of the process operating, but we want to make sure that we're starting to get the value of the negotiations that we have in place. So the requisition might, depending on the category of supply or the person that is raising the requisition, the role that they perform, the system can start presenting the preferred suppliers to use for that category of supply. It might start prompting for justifications as to why you would use an exception away from those preferred suppliers. If you have an arrangement where you want to spread your spend across a group of competitive suppliers, you can start organizing that. So you might have, 50% there, 30% there, 20% there, so that you can drive competition amongst your suppliers and get good price pointing. We've mentioned custom catalogs there with your pricing, and of course you can capture contracts that you've negotiated in your sourcing piece of work into the requisition. The benefits of these is that you start driving the benefits of your negotiations. You start getting the discounts that you should. You make sure that you're using the suppliers that you should be using, and you reduce maverick purchasing. It reduces dependency on a purchasing team to source each transaction, that you can let the transactions go through. So this is where we can have more and more self-approval. We can get all the benefits of preferred suppliers, good relationships with suppliers, and we'll start ultimately seeing goodwill pricing appear as a result of the suppliers getting the spend that they should be getting. As we go beyond that, we start looking, what does this mean collectively for us across the process? What it means is that we're capturing patterns of seasonality. We might be getting information around compliance to process. We can see where people are kind of not following the right process or not following the right suppliers. It can be addressed. We can start getting information that helps us to foresee whether we're going to be on budget, whether we need to adjust the forecast. We can look at, what funds have we committed to a particular spend, if we're doing project builds, what have you. And we can really drive that sourcing focus to look at the right areas where we might have some gap in our supplier base. So starts getting really powerful if we start looking at this patternistically for our business. So Peter, yes, this session is being recorded. Yeah. Okay, if we move on to the actual purchase ordering. So this is the converting a requisition into a purchase order and instruct the supplier. So again, if we go back to the most basic level, we're often talking about verbal instructions or email instructions, or kind of maybe there's a manual reference from a sheet, or even going back to the early days of my career, a piece of paper with a carbon copy at the back. But very manual. Again, this suits a lot of businesses. I don't want to take that away from small businesses. It works for them. It suits them. That's fine. I have called out a risk there that, of course, whilst it's an informal process, you're very much subject to the supplier's terms and conditions and reasonable terms in contracts between the two parties. If we get into the more formal process, so we start thinking about transaction control, we have a purchase order in our system, whether it be created from scratch as a purchase order or whether it be converted from a purchase requisition. We start getting something which is in effect the contract with the supplier and has terms and conditions which we would expect the supplier to respect. We can start looking at the release controls around purchase orders. Do we expect any particular purchase orders to be seen by a technical expert, by a particular budget holder, by somebody that might say legal if there's a sensitive style of purchase going through? So we can start looking at the workflow of purchase orders before they're finally released to a supplier for supply. And obviously the benefit here is that we start driving compliance to the purchasing disciplines. Non-compliance we call maverick purchasing. So we address those maverick purchasing issues. We make sure that we're getting the best benefit, and we start getting commitment reporting against spend. We can see that against budgets, whether it be a cost center budget or whether it be a project build or something like that. We can start seeing how much money have we committed, where are we at. Also in driving efficiency, we can start doing the workflow I mentioned about going to the specialist buyer queues. We can start delivering purchase orders via e-commerce, especially if we go out to a supplier portal, which I'll come back to a little bit more in when we get to invoicing. But if we start this is our business's supplier portal, this is where you find your purchase orders. That's a great way to operate. Obviously, we can email purchase orders and deliver. For large businesses, we can deliver peer-to-peer purchase orders. The benefits of this, again, obviously reduce cost of transaction. We can build confidence in delivery to the supplier, so we know we can address purchase orders getting lost. We can make sure that they're getting those purchase orders. We can actually start building in acknowledgements, so the supplier acknowledges the purchase order. You can have confidence that you're going to get what you're hoping for when you expect it. And it enables you to start having a more sophisticated purchasing organization. So you could have specialist category buyers if necessary, and route the right transactions to them for their attention. That allows them to leverage their specialist knowledge in the marketplace. If we go more strategically, again, it's similar to the requisitioning. We can be driving the use of preferred suppliers, so bringing exceptions to buyers' attention, allowing them to change the supplier if there's no valid justification for the exception. We can balance that multi-supplier sourcing we mentioned in requisitioning. We can ensure the right contracting and pricing in terms, which is something where our employees can often get persuaded away from our standard terms and conditions. This gives us an opportunity to reapply them and make sure that we're trading with the right terms with suppliers. And if we're making sure that we're going through the right supplier base, we can ensure that we're getting our volume rebates and volume discounts appropriately. And so all good benefits around realizing the negotiated benefits for all of our transactions. And then as we leverage this process, obviously we start getting information about the buyers, the actions that they've taken, how we're sourcing, are we getting the right deals? Are there areas for improving? We can take this into negotiation intelligence as well, in terms of quite often suppliers will come to a relationship meeting and not know how much business you've given them. If we've got this number being reported well, it's being reported consistently against contracts and source lists, you can really leverage that relationship and that almost ignorance on the supplier space about how much you're buying from them. And you can demonstrate your ability to buy from them reliably and to drive pricing. It's a really powerful mechanism. If we go on to goods and service receipting, obviously the most basic version of that is that there's no receipting at all, which means when we're releasing the invoices, we're either releasing invoices blind or by asking around, and so obviously there's an overhead there. If we start applying transaction controls, obviously we have a goods or service receipting against a purchase order. We can allow for adjustments or blocking of invoices for things that do not pass inspection, and items that might need analysis after receipting, but we do it after the receipting. So you might have, for example, bulk chemicals where there's an active ingredient and you pay the volume that you receipt is based on the active ingredients and the bulk chemicals. And so you can adjust what have we received at a later stage. But the key principle is when you receive the goods or service it, receipt it at that point, and you can make adjustments afterwards. This really protects us against under or over delivery. It enables us to three-way match. And when we say three-way match, we can match the invoice and purchase order in terms of pricing and quantity, and we can match the purchase order and the goods received in terms of the quantity being received, and we can confidently pay invoices correctly. And it also enables us to inventory manage some goods. As we start driving efficiency, obviously the key thing here is to start using technology to enable the receipting, and we start looking at barcoding. We might use radio frequency identification. There are other emerging technologies such as voice receipting coming, but fundamentally it's to make the task easier for the human, reduce the effort and reduce the risk of error. And I reflect back on experiences in the past where I've seen the post-it note in the stores with the purchase order that everybody receives the goods against. So we can take that risk out of the loop if we have technology enabled receipting. Obviously the next stage onwards is also around the benefits there. I've already mentioned the accuracy. So we reduce the effort, we improve the accuracy. As we go on to kind of a more strategic level, we can be looking at relationships and almost reducing the need for us to manage an inventory. So we can be talking about vendor managed inventory. We can be talking about metered supply. So this is where we will draw on goods, and we can even do this for services as well, as we need them, as we consume them, and we get receipt. We receipt only the amounts that we've consumed. And in a vendor managed inventory or VMI situation, that's done on our behalf, and all we need to do is just verify that we agree it. You can do that. I've done that in terms of the metered supply around hydrogen supply into a bulk chemicals manufacturer, electricity supply into office complexes and similar types of thing. The real benefits of this are it's not just the transactional efficiency, you're starting to reduce your working capital. Somebody else is holding your stock for you, but you've got the capability to draw down on that inventory as and when you need it. So the warehousing cost is gone. You don't have to worry about the reorder quantities. That's somebody else's task, and you've just reduced the working capital there. Much easier way of operating. What it enables you to do as you start going beyond and leveraging the process is that you can go beyond thinking about what's my purchasing strategy into what's the purchasing strategy for my suppliers. And you can start looking at the whole supply chain, and where you have core goods and services that you need, having your suppliers organize them, having them buy them in the most efficient way and the best way so that they reduce their costs and pass on that cost saving to yourself. And this optimized supply chain enables you to produce a really economic supply base, have confidence in your supply, reduce the inventory that you need to hold and therefore the working capital. And ultimately, it has a benefit in terms of enhancing the capability of your suppliers, but also delights your customers. It demonstrates that your business will have a greater capability. I've done that in many industries around bulk chemicals, pharmaceuticals, hotel linen. It's a great area where we've helped the supplier to get better at their supply chain, and they've passed on savings to the end customer company. So we go beyond that into invoice processing. So this is kind of the recording of the invoice, not the approval of any discrepancies, what have you, but this is recording. So again, the most basic is that there's a manual recording of the invoice. Now, I don't think there's any business that doesn't record its invoices. We need to report them. So it's the most basic is a manual recording, maybe in a ledger. Obviously, the next level up is that we're recording invoices against purchase orders. Now, many businesses don't use purchase orders. And so they start having risks of paying the same invoice twice, duplicate invoice processing, paying invoices that are not for them. We've seen businesses that have invoices passed to them, literally a passing off of invoices where there's fraud. You might pay the wrong amount, you may pay for things that you haven't received. So what we want to do is drive a purchase order policy as much as possible. Make sure that we're using the purchase order and recording an invoice against it. Not doing that, we call maverick purchasing. And there's a little bit of a lookout that we'll come back to later on in terms of managing the process. But really, there's businesses start looking at a no PO, no pay policy. As we start driving the efficiency, we can look at recording invoices using optical character recognition. And there's kind of really two levels of that capability. One is the trained level, where you might receive the same invoices from the same supplier again and again, and you can tell the solution, this is what the invoice looks like. You'll find the address here, you'll find the invoice number there, the date is here, here's the item detail over here. It learns how to do it, and away you go. There are also intelligent solutions which take a little while to train up, but they can then interpret invoices from any supplier, regardless of the layout. And so that's great for dealing with tail end volumes from varied suppliers without the need to train the solution for each supplier. That's a great way of doing things. The best way of doing things, in my opinion, is the e-commerce delivery. So we mentioned earlier about punching purchase orders out to a supplier portal. It's great to get your invoices in electronically, whether it be email, but if it comes from a supplier portal, oh, that makes life so much easier. The absolute best performing way of doing this is for your supplier to press a button saying invoice and to flip your purchase order around into an invoice from a supplier portal. There's no errors, no risks, or very limited risks. It comes straight back to you. It's in your control. It makes the supplier feel very confident, and it takes away all manual processing around that. It's a great way to operate. We mentioned ghosted procurement cards earlier on in the requisitioning. Obviously, if we're using those, we'll also get a feed from the ghost procurement card provider here, which relates back to those requisitions. So you can process them through, have the right analytics, and have confidence that those purchases were good. All this enables us to reduce the cost of operation, massively increases accuracy. And here's the kind of the soft benefit. It drives reputation because you become easy to work with. As you start driving more automation, there's more accuracy. You're following a good process. Your supplier finds it easy to work with you. You start driving your reputation. You start looking impressive as a company around this particular aspect. If we go into the strategic sourcing, it enables proactive supplier relationship management. So you can start looking at how suppliers trade with you. You can start taking suppliers on a particular process journey. You can start asking suppliers to give you preferred rates for being preferred suppliers that you take through your process. So you can demonstrate to them, this is our process, this is really easy to work with, this makes sure that you get whatever portion of our category of spend here, it makes you a preferred supplier. That's really good, isn't it? Isn't that worth a few pennies of discount? And it becomes really powerful. It helps us to get beyond maverick purchasing processes where people might verbally instruct suppliers when they shouldn't, where they promise to get invoices paid that they shouldn't, where they might take credit notes in and put them in the desk, because people never know what to do with credit notes. They just put them in the desk. But it gets suppliers engaged. It allows them to believe that they're in a good place if they start following your processes. It generates goodwill. And most businesses start going down the no PO, no pay route, which is okay, which normally comes to life in the form of sending an invoice back to supplier and saying, we're not going to pay this invoice. The reality is that in most cases, that invoice will bounce backwards and forwards about 15 times. There'll be several phone calls, and everybody will dislike everybody in the process, and it will ultimately get paid. A better process is to take that invoice and contact the supplier and say to them, we really want to pay you, but this has been handled outside of our process. So here's the way to get back into our process. And by the way, if you come into our e-commerce process, this stands you a much better chance of being a preferred supplier in the future, and it's a much easier way to work with you. This is an opportunity to really get your suppliers working the way you want them to work. It's really fantastic. The results are great. It leads to on-time payment performance, and it leads to great supplier relationships. If we go to kind of the really strategic level, we can start looking at transaction patterns. And what does that mean? So I liken this to, if you've ever, had kind of a contact from your credit card provider, your credit card is being used for an unusual purchase. Was it you? Or I remember a couple of decades ago, every time I bought currency at an airport, I'd get a call from my credit card provider. Is that you buying currency? What they had was kind of an intervention that looks at how is your card being used. And it's the same thing you can do in invoice transaction. You can start looking at what's the pattern of invoices as they land in your solution, as you're recording them. Is this telling us something about our business? Is there something that we need to react to? I used this when I was in a pharmaceuticals business, and I think everybody knows from the COVID story that the pace of bringing drugs to market is really important, and that whole approval cycle is a critical factor. The way that happens is that doctors are engaged into clinical trials to take X number of patients through recording their treatment and the results of the treatment, and they'll get paid a fee for that. We spotted that we were getting part invoices against clinical trials purchase orders, and we could intervene on a clinical trial before our medical team could see that it was going off plan. If we had not intervened and said, this looks like it's not going right, there's a problem with this clinical trial, that clinical trial could have been extended several months. And that was worth a lot of money to the pharmaceuticals business I was in at the time, and also meant that we could bring the drug to market and help our patients at an earlier time. This is an example from the world I've been in. I'm sure that there will be examples for your own businesses where you can look at what's happening in terms of invoicing, and it might trigger a reaction that is preemptive compared to what you're capable of doing today. So that enables us to have alerts coming from our transactions and respond to them in some way. Then we'll go on to talking about releasing the invoices for payment. So again, going back to our most basic operation, and again, this is absolutely fine for small businesses with very few people. It might just be simply, this invoice is due for payment. Are we happy that we got the goods or services? Yeah, it's all good. Let's make the payment. That's absolutely fine. The next level up, if we're starting to talk about building some process controls around that, we can look at that invoice recorded in our system. We can have a two-way match for services being delivered that haven't been receipted. We can say, does the invoice, does its price and quantity match the purchase order, the specification same, and we can release that invoice ready for payment. The three-way match is the same kind of thing, but for goods. Obviously, we're looking at the goods receipt if the numbers match up there, and we can have an approval workflow for those invoices if we want to say, yeah, how are we going to release them? Who's going to approve that they're released for paid? And we'll see all invoices going through that route. It helps us with discrepancy management. Those approval workflows can be for all invoices. It can be for the invoices where there's a difference We can define whatever workflows we want around it, but basically it makes it easy to have some controls around making sure that we pay for the right things and that we pay for them only once, the right number of times. If we want to start driving efficiency, we can start addressing things like the classic challenge arising from e-commerce, where early ERP systems like SAP and Microsoft Dynamics and what have you were geared so that the goods were received ahead of invoices being received, and invoices were matched to the goods receipt. In the e-commerce environment, it's pretty much the other way around. We often receive the invoice before the goods, and so we have flexible workflows in terms of how those the sequencing is defined. That's kind of driving the next step of an efficiency. If that's not possible in the solution, then it's a kind of a discrepancy represent kind of process. Where we have a genuine discrepancy, where there's been a difference in the goods or quantity or the value or the pricing or whatever, we can have a discrepancy workflow. So this is where we take the invoice and we route it maybe to the original requester. We might route it to a budget holder. We might route it to a technical approver who might look at a particular category of buys, and they will agree whether that invoice should be paid or not. Now, that you could do that for 100% of your discrepant invoices, but you can also start applying some smarts around that. So things such as negative confirmation. So a negative confirmation is a process that IBM originally developed for their own business, whereby they'll give the person that requested the purchase a certain amount of time to say, don't pay that invoice. And if they don't take that action in that length of time, the invoice will be paid as it becomes due. So they had the chance to say, intervene and say, don't pay during the normal terms of that invoice. For some higher value transactions, that might be considered a little bit risky. So they then had positive confirmation level, where they say any discrepancies above this certain value must be reviewed before they're paid, which is great. So that gives us a nice balance of the cost of control versus risk. It also prevents us from reviewing every transaction and being late in payment. So it enables on-time payment. The next level up in terms of caring for our suppliers around this release is making sure that if we do have things that are on positive confirmation processing, that we're hurrying them along for the supplier's benefit. And that's called deadline monitoring. So it might be, if there's a positive confirmation required, or even a negative confirmation, if it's not happening within a given length of time, rather than just leading up to the payment terms, but maybe 3 days or 4 days, it will escalate the organization for attention. So that person's lost their right to intervene, it gets escalated. If that person doesn't respond, it gets escalated. And again, it'll either automatically release if it's a negative confirmation, or it'll hold at the most senior person if it's a positive confirmation, waiting for their approval. It just helps us to get to driving on-time payment performance. And that on-time payment performance can be massively valuable. I worked in an organization, again, it's enterprise level, where I was basically responsible for $6 billion of spend each year. And we had a really super strong sourcing organization, strategic sourcing. We had negotiated huge discounts. But as we drove the performance around on-time payment from kind of mid 70% up to 99 point blah, 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 blah %, that generated, beyond our normal discounts, somewhere in the region of 0.5% to 2% pricing benefits on $6 billion of spend. It's really powerful when you think an AP team can do that for your business. So it's really getting to on-time payment is really a powerful negotiation tool. If we look at this on kind of leveraging the process, the things that are discrepant are the things that didn't go to plan. So we can start looking at discrepancy analysis and learning more about our business. Are we good at forecasting? Is our order book reliable? Have we got the right sourcing arrangements in place? So, have we got good suppliers? We can start looking at all of that performance around purchasing and start feeding that into the supplier performance review, sharing that with our suppliers, getting their perspective on it, looking at how we can smarten that up. How could we work better with them? How could they work better with us? So we get a lot of information from having this discrepancy workflow in place. So don't just think about it as an efficiency tool or a control. It can be a business intelligence as well. So we're nearly there. We're onto the payment. Again, the most basic level is kind of a manual instruction to a banking system. And if we're operating in the US, we're still using checkbooks there. Again, suits very small businesses, works well for them. If we want to start driving control, we can start looking at closed bank instructions. So an instruction to your bank that's driven directly from your ERP solution, your accounting solution, without a human intervention. And then it's the transmission of that instruction to the bank that we have a two-step authentication around. So we're all familiar with two-step authentications now, whether that requires an answer back solution from one person or whether there needs two or more people to be involved in creating the bank instruction. This is the biggest area of risk that any business has. They can have any number of controls upstream, but quite often you get to that ability to instruct the bank or manipulate an instruction to the bank, and it's the biggest area of exposure. And I've seen a client in the past who accidentally misinstructed about £4 million into a private bank account on a Friday afternoon and managed to recover it on a Monday morning. It's a big area of risk, and it's what we need to be locking down. Obviously, just for the check printing world, we can also lock this down with something that was invented by Frank Abagnale, is the plain paper mica check printing solution. So you have no check stock. So the next time the auditors ask you, where's your check stock? How do you maintain it? The answer is we don't have any. We can just produce it with magnetic and character recognition printers. But I guess that's not very much required these days. Obviously, getting these things in place secures the bank account. It's the area I've been most careful about my whole career, is just that ability to instruct the bank account. Everything else we can kind of engineer and improve, but protect the bank account by all means. In terms of driving efficiency around this, we can start looking at having integrated bank instructions or combined bank instructions. So, you might have a service from your bank where you can send them an instruction file for SWIFT payment, BACS, ACH, any gyro payments in Scandinavia, any kind of instruction in a single file, and they'll process it for you. We can look at automating the daily bank statement reconciliation. So really good practices to get that in place, where we're making sure that we're checking the bank statements every day, balancing it to the penny, and we've got good confidence that there's nothing untoward going across the account. Great control, but also it's great if we automate that. And if we're doing it on a daily basis, the reconciliation and the automation of that becomes much easier. One thing that I've done in the past as well is separate out direct debits from your bank accounts. You could have a bank account dedicated to making your supplier payments. If you separate out direct debits or have a really good way of managing them, you can drive efficiency about that whole reconciliation and knowing what's come across your bank account and have confidence that it's all good. I mean, and this is all really around the efficiency of making sure you're sending the right instruction and that the right instructions are hitting your bank account. As we go beyond into a more strategic level and start thinking about, again, our reputation in the supplier base, our operation, we should be driving towards payment to terms. And our way of doing that is to drive towards daily payment runs. Now, that's counterintuitive or counter appealing for many people, but the rationale being, as you get closer to a daily payment run, you also get closer to being able to pay an invoice on the day that it's due to be paid without, if you want to be on time, if you've got weekly payment runs, you might have to pay a few days in advance or choose to pay late. So as you get closer to daily payment runs, you get closer to being able to pay an invoice on the day that it's due for payment. One of the side benefits of this is that on your supplier portal, where your suppliers are receiving their purchase orders, are seeing their invoices, can recognize the payments coming, you can start offering nice solutions like dynamic discounting, where a supplier might offer you a discount for early payment and include an invoice in an earlier payment run. And of course, the discount that they offer exceeds the cost of cash of paying them early. So it starts creating a benefit for you, and it's a perceived benefit for your supplier. So it's a win-win. Everybody's happy, and guess what? That comes back to you in pricing benefits. If we leverage this across our business again, we can start looking at how do we avoid bank charges, how do we manage cross-border payments, do we loan business money across entities so that we're not transferring money across borders and attracting charges. We start working with our banks about straight-through processing. So what corrections are happening in the bank transaction systems that we don't know about, that we need to build into our master data, and having a feedback mechanism for that. We can start looking at, should we sweep cash out of our current accounts into investment accounts overnight? And kind of the next level up from that is zero balance accounts. Should we kind of maintain a zero balance in our payables bank account and only fund it with the amount that we intend to instruct on a particular day? Really, really powerful. Really make sure that you're getting the most out of the cash that your business is holding. Again, it reduces cost of operation because it's an easy, once you get there, it's an easy way of working, and you can generate income from your available cash. Finally, we're getting to process management. We're nearly there, folks. So at the most basic level, we kind of, if we're managing the process, we're looking at tasks and managing those tasks on a daily basis. Have we done it? Are we doing it? Type of thing. As we start looking at controls and we start thinking about our process, there's things that we need to be looking out for. So there's a thing I call perfunctory purchase order. And this is where the purchase order is created after the invoice has been received. So there's apparent compliance to a purchasing process, but actually there is no compliance to a purchasing process. It's just somebody hiding the fact that they've instructed the supplier. You might be losing the benefit of negotiation. You might be losing the benefit of sourcing. Look out for those. Just have a report and deal with it. Another risk to look out for is somebody manipulating their budget by cancelling purchase orders over the year end. It's obscure, but it's something I've seen before, where it looks like somebody's got a commitment and then they just cancel those orders and wait, hey, they've got extra budget in the following year. Look out for people trying to break the approval levels with salami sausaging, so splitting a single purchase into many lower value purchases. You can get smart reports around that. And of course, we need to be having checks around any manual adjustments that our teams are putting into the system, looking out for internal fraud before the payment runs, looking out for duplicate invoices. So our systems have a check upon entry that this looks like a duplicate of a previous invoice. Are you sure? And of course, the thing that auditors always require us to have is our statement reconciliations in place. Now, we could treat that as an annual event that we have to do for the auditors and kind of doing our top 10 suppliers. But actually, if we're driving efficiency, we can start looking at, we'll go a bit further. If we're driving our sourcing, we can start looking at using that as a real insight tool. Just before we get there, we're kind of driving efficiency by looking at these reports and looking at how our transactions are executed and how long each step takes. We can start identifying where there's a need for improvement, where our teams are struggling, where it's not as easy as we think it is, and we can help improve the process. We can look at automating for large transaction volumes where there's inventory that's managed, automated clearing of the goods received not invoice account, and make sure that we're keeping that nice and clean. We can use fuzzy logic to suggest the right clearings and clear that down. And a great benefit for our month-end close, our budget holder operations, and kind of our financial reporting is off the back of a good process where we've got good, healthy purchase orders, we've got good compliance to a process, delivery dates are accurate, we can start automating the accruals calculation each month. So we can take that whole effort out of, what have we bought but we haven't been invoiced for yet. We can have an accrual, build that up for us, and it can be done automatically. The next step on kind of leveraging the relationship with suppliers is having a continuous post-payment audit. So it's like statement reconciliation, but treating it as an ongoing cyclical activity. And what you may find is that you have transactions where you've paid both through your accounts payable ledger and through an expenses claim, or you've got a supplier that has a rebate available at a certain volume of spend that they're not reflecting and not respecting. You can go out and get that rebate. You might notice that there's a statement from your suppliers that says a credit note has been presented, but it's still out in the business somewhere because people know what to do with an invoice. They send it to accounts for processing and payment. With a credit note, they quite often don't know what to do, so they say, "That's really nice, thank you very much," and keep it in their email or on their desk, whatever, or put it in a drawer. So you can identify those erroneous transactions or missing transactions and get them captured. As you push into kind of looking at the whole process end to end, looking at these reports where you've got compliances, where you've got timing issues, where you've got challenges, you can start really balancing out the cost of control versus the risk. You can make sure that your process works well for both yourselves and your suppliers, so you can maximize that goodwill from suppliers. It automatically helps you to have a better organization reputation. People will be willing to trade with you. They'll be willing to trade and give you, if not pricing benefits, service benefits, a level of service that other people don't get. It gives you the information, good, clean information to go and have strong conversations with your suppliers and drive their performance. And it helps you to identify those things that are getting in the way of your core business. So you might have delays on things being available that are required, and presenting a delay to your core business going out. It just helps you to start looking at what that critical path is through your organization, and maybe getting smarter about earlier ordering, faster delivery times, better relationships with suppliers that can deliver to different points, all sorts of clever things. And it will all be different for each of your businesses, but you can start leveraging that information. A lot of this will be in your heads as smart business leaders, but if you can start getting into reports and analytics, it might highlight things to you that you hadn't thought of before. And finally, master data. Obviously, it can be manually maintained and input, which is great. As we start getting some control around it, we might want to look at how that master data is released into use. So it's blocked upon entry, upon amendment, and then is released by somebody approving it, saying, yeah, that follows all our conventions. It's not a duplicate. It's got the right coding, blah, 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 blah. The bank accounts look right. I've checked for duplicates, so we can't have two invoices on two different vendor accounts, so the same invoice on two different vendor accounts being paid twice. And it helps us control the bank details. That's fantastic. We can enable that through things like using optical character recognition of details, and when suppliers will change their bank details from time to time, you can read that off the face of invoices. But the by far most powerful way to maintain master data is not to do it at all. Get your suppliers to maintain their own master data. Get them onto a supplier portal. Have them maintain their master data and take accountability for that. This might come from transactional processing, or it might be started through an RFI, RFP, a request for information or request for proposal portal, which you might also use for reverse auctions. It's really powerful. All of this together just helps you to evaluate the cost of doing business with suppliers. You can look at the decisions that you make around sourcing, and what's important in terms of performance management. It'll help your suppliers to be incentivized, get the best deals from them, and enables you to be operating your process as well, and ultimately paying on time to leverage that relationship at its best. That's an hour's worth of talking about the P2P process. I hope that was of interest for you. Next month, we're going to talk about finance reporting maturity, a similar kind of structure and style. We'll talk about the various levels and hopefully inspire some improvements for you. In today's session, if I just recap, we talked about why we use a maturity model. We talked about how we evaluate and characterize the impact. We went through the scope of the purchase to pay process and what we would include and wouldn't include. We talked about the 5 maturity levels, going from the most basic operation to kind of quite advanced leveraged strategic impact. We talked about what characteristics you might see in each of those levels, and what I've given as examples. They're not prescriptive, they're by no means fixed, but it's kind of examples of what you might see in each of those levels. And hopefully, if there's any questions, I can address those now. Okay, I'm going to just move on. To find out more from us and think about your next steps, please do come to our website. There's a little quiz there that takes about 5 minutes to help you consider what might be the right next step for you. It'll ask a few questions and help you suggest what might be a good forward step for you. In the very near future, we'll be having a requirements template download available to help structure your thinking. And if you would like some help with that, please don't hesitate to message us, and we can come back and help you with understanding those requirements. And why not speak to one of our consultants? Please, book a discovery call. We're more than happy to talk about the art of the possible, what next steps could be, and offer some guidance and advice on that. We'll be very happy to do that. So I'd like to sign off, but thank you for attending today and watching this recording. This is Neil Inchhorn for ITAS Solutions.